You're about to join Jerry Parker, Moritz Siebert, and Niels Kostrup Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Jerry Parker and I, Niels Kostrup Larsen, are back with this week's edition of the Systematic Investor series, where each week we give you a raw and honest account of what it's like to be a rule-based investor, what news and articles caught our attention, and of course, where we also attempt to answer all of your questions. And as they say in the financial news channels, Moritz Siebert is out on assignment this week. So it's just you and me, Jerry. How are you?
Doing great.
Good stuff.
It's Mother's Day here in the States, so I'm not sure if Europe has a Mother's Day, but happy Mother's Day to all the mothers out there.
Yeah, happy Mother's Day. Unfortunately, I am not home celebrating Mother's Day. I'm actually in Monaco today. Not that I'm complaining, but I can't be there to do what men should do for the mothers, of course. Getting ready for a conference starting tomorrow here in Monaco, and I saw that you had a tweet out this week in relationship to conferences, something about the hedge funds stayed away from the glimmer or whatever, the glamour of the conference circuit.
Yeah, I was sipping on some Pinot Noir this weekend, and that's always dangerous when you start tweeting. But you and I have been in the CTA business for a long time. Over 30 years for me. So we've been to a lot of conferences, and they're mostly just fun events, but they're a little frustrating in that there's a lot of money spent and not a lot to show for them outside of hanging out with your friends and drinking more Pinot Noir. But so this article I saw in the Wall Street Journal, the headline is "Hedge Funds No Longer Stars of Their Flashiest Conference." So SALT, I guess, has lots of political people and non-hedge fund guys who are sort of featured, I guess, to get the attendance up or whatever. And I just remember over the years, I didn't feel like that a lot of the conferences that you and I would go to, that the CTAs were sort of featured at a CTA conference. So I guess to maximize the revenue for these conferences, that they're not always going to be CTA-centric or hedge fund-centric to entertain people. It's a little frustrating over the years to deal with that.
Yeah, no, I agree with that. And maybe there are some conference organizers listening to our conversation today. And I think there's a danger in the way these things have changed. I mean, I remember back in this would have been probably in the early 90s when it was the MFA, and as you rightly pointed out, back then it was the Managed Futures Association, not the Managed Fund Association. And at those conferences, you would go there and you would have at least an hour with the investors. It would usually be decision makers showing up, and you could really have. I certainly remember some conferences where we would have 20, 30 really long, solid meetings. Nowadays, not only has it turned into this speed dating where you get 15, 20 minutes with each, but I think they're struggling to get the number of investors because I think at least a lot of the people I've spoken to on the CTA side, struggling to get the number of meetings that would even justify you spending time and money to go to this. So I think they need to up the ante a bit and make sure that there's enough investors and there's enough interest for the strategies they want to show, want to have show up at these conferences. So,
yeah, I think what's been more popular than podcasts and trading podcasts to listen to traders and listen to managers. It's just so much fun to hear it. We're bringing on more outside people. Plus the experiences that we've had. And then what books are more popular than Market Wizards and interviews of traders? And I just, and I can remember back the very few times that I've gone to these conferences and a star trader, David Harding or Paul Tudor Jones or someone like that spoke, because it's so rare and yet it's so much fun to hear from these famous and successful traders that it is a little surprising that there's not a keynote speaker from Aspect or Winton or Transtrend or Bridgewater, some trader type done. Yeah, I mean, think about it. There's a lot of famous traders out there with long track records that are still crushing it. And I mean, even though the CTA performance has been down a little recently, but it's at least that's what turns me on, is listening to and reading about famous traders. They talk too much. They tell too many good secrets.
Well, one interview I saw this week that I felt was very good was about a certain turtle that I speak to every week on Real Vision. So well done, Jerry, on making it to that media platform, which seems to be growing from strength to strength. So that was pretty cool.
Yeah, I had fun with Joe Perry doing that. He's a good interviewer, and we had a fun time in New York.
Yeah. Absolutely. Well, that was a kind of an alternative way into today's episode, talking a little bit about these things. But of course, it was a week where there was clearly an elevated level of volatility in the stock markets. And we know that's obviously because of other tweets, not necessarily your tweets, Jerry, but other tweets, let's put it that way. And a US-China trade talk. But I think generally speaking, I think trend following strategies did okay. That's my sense. And from a market perspective, of course, stock markets were hit, even though they tried to make up for it on Friday. But there were big moves in grains. There were big moves in things like cotton, certainly on the downside. And on the upside, I noticed that, of course, not surprisingly, VIX had a big move up, despite giving back a lot yesterday. And fixed income markets, had a bit of tailwind as well. So with that in mind, I usually say, Moritz, take it away. But maybe today I have to start, today telling a little bit about how we saw the week from our perspective. And, it was a solid week on our side and a pretty good start to the month of May as well. But it was, once again, certainly in recent times, I mean, the grains really played a key role for us this week. Good gains from this continued downtrend that we see, and in some of these markets, they're really strong downtrends. We also saw some weakness in cotton, which I think could potentially have been our biggest winner this week. So, nice to see these kind of smallish markets also having an impact on performance, especially for those of us who believe in diversification. So that's good. And of course, I mean, fixed income, every time there's a tailwind at the moment with the lower yields as a result, it's useful for us. It's useful, I think, for most trend followers, because that's where the big trends have been recently. So that helped as well. And then we lost a bit of money on stocks. We lost a bit of money on currencies. But other than that, it was a pretty good week overall. How did it pan out for you, Jerry, on your side?
Yeah, it sounds very similar to our experience this week. Last week, it was a nice rally in cotton over the past couple months, and we sort of held on. That's a nice one. It's good to see that longer term trend can reassert itself after a uncomfortable rally. So, and yeah, like I said, we are big in the grains as well, canola, but corn, wheat, and soybeans, and milling wheat. We trade that as well.
Mm-hmm.
And everything else is pretty quiet. Dollar pretty quiet. A little sell off in stocks, but yeah, sort of a positive week.
Yeah. Well, are there any of the single stocks? I mean, I don't know if you looked recently, but are there any of the single stock? I mean, of course, with these big moves we've had in equities, generally speaking, so far this year, what happens in a single stock portfolio? Do they all just go on a rally, or are there still actually equities even within your portfolio that are still in a downtrend, or are they all now pointing in the same direction?
Oh no, there's some in a downtrend, some in an uptrend, whatever, it's just like all the other markets, as if they were not related. There's all sorts of different chart patterns. Southwest Airlines, this hasn't moved in a long time. It's sort of sitting there in the middle of consolidation. McDonald's and Starbucks made new highs this week on Friday. So it's just sort of like there's nothing going. Everything looks different, and then all of a sudden, everything for a day, a week, or a month, it all goes in the same direction.
Yeah.
And maybe you get short, maybe you get bounced out of the longs, or maybe you don't. So it's lots of diversification until you have a week like this week where, almost every stock is down, when the Dow is down 500 or 400. So you just got to hold on and hope you don't get knocked out of everything unless we have a new downtrend coming, which doesn't seem like we are going to have or have had. So,
sure. Yeah. There's certainly a lot of opinions around this. I mean, I listen to other podcasts with people that, to a large extent, I respect their opinion, even though, of course, as we talk about on our podcast, that we don't put a lot of, I wouldn't, the word is not value, but we don't have much confidence in sort of the discretionary type, fundamental type analysis. We prefer the rules-based, but there are people with obviously interesting opinions. What again, this is, there was certainly one podcast out this week where they had this guy from Nomura, Charlie McElliott, and his CTA model, and it's interesting. And this was Macro Voices, a great podcast with Eric Townsend, but it's funny how in those type of scenarios, this CTA model gets a lot of positive coverage. Even though when I listen to it, I would say it's not really a CTA model, how I would understand it. There's certainly some momentum indicators, but it doesn't seem to me that it's operated how we as trend followers or CTAs operate. But it gets a lot of coverage because it's portrayed as something saying, oh, if we have to hit this level, then the signal is going to go from 100% long to 60% long. So there must be a lot of selling coming through the system and so on and so forth. So I'm not sure why there's so much importance being put on that particular model, because I don't think that's really how it works in our industry, at least. How about a little bit of social media tweet? We got lots of questions this week, so that's great, and thanks so much for sending them in, and keep them coming. Send them to info@toptradersunplugged.com so we can dive into that. But Jerry, Twitterland this week, how was that for you?
I've got a couple fun things to talk about. Cliff Asness at AQR. He's a friend. He's a trend follower in some of his products. So he was in Chicago speaking and catching a lot of grief for performance and the lack of performance for his factors and for momentum. In his response, a couple of articles, I tweeted his response to the criticism. He says he intends to stick like grim death to his beliefs and work on improving his explanations to help investors better understand what he offers. Quote, "We don't have a strategy problem, but we do have an intuition problem. We don't know if there is a long-term problem or if there's a short-term thing. Our reaction has been a non-reaction. We think it's a blip and the fundamentals in the markets haven't changed. It's a gradual deterioration rather than a sudden cliff edge." No pun intended. So I think this is a typical strategy that we all would have, is that we still like what we do. We can have, unfortunately, longer-term periods of underperformance than we like, but we're going to stick with it and trade smaller or preserve capital and try to get through a period that doesn't perform as well as the stock market, which is free and easy, and it beats everybody, and it's beating us. And So no surprise, but I thought they got a lot of reaction, and I think people like for you to stick to what you do, but they like to see it start performing.
Yeah, I mean that is the challenge, isn't it? And it's also this challenge about a lot of people when they don't perform, then there's this tendency to go back to the drawing board and make some changes, et cetera, which is of course can be a dangerous thing to change. I mean, it's this debate. Should I change because it's not working? But if I do change, may I miss out if market starts to come back in their normal fashion? I mean, I think still, and I, we have a lot of respect on this podcast for AQR and Cliff Asness and for what they do. But I always come back to this point because it's something that obviously we debate very frequently on the show about, has trend following stop working or is it less efficient? And of course, we would argue, and I think still the data suggests that all strategies will go through periods of underperformance or low performance. But I do worry myself, and I know I've said this 1,000 times. I mean, I do worry about people trying to do trend following with these enormous amount of money, thinking that doesn't have an effect on performance. I just haven't seen it ever, that it doesn't compromise performance if you want large AUM, and I think that's a big challenge for many people. The temptation of growth when you can get it seems to often take the upper hand in these businesses, and I think it's a shame because it leaves the whole industry slightly with this image that things don't work. But I think you and we and others are testament to the fact that it continues to work. But it doesn't mean it work every month, every quarter, every year. But it, no investments or investment will do that, of course. But there's a lot of pressure from investors because they have to report to their clients. So I understand the scrutiny, but it's a tricky balance indeed.
Yeah, and everybody, there's lots of articles that we read all the time about the majority of the money continuing to go to the largest firms. So to some degree, the problems with large AUM is being fed by investors as well, out of safety or but yeah.
Yeah, that's a good point. Actually, that's absolutely a good point. That the people complaining about lack of performance could potentially be the cause of it because they all go to the same names. So that's, I think, that's a very valid point. Yeah. What else did you see, or what else got good reactions or bad reactions, so to speak?
Well, I had the biggest reaction was from an article that I got from Elm Partners, Elm Funds, was interviewing a NYU professor who was talking about momentum. It seems to be favorable for momentum. And this one, I don't know why it got so many likes, but it was one of the biggest ones this year. He says, pretty much all of trading can be summarized into two groups. You can either be a momentum player or one who detects shifts in momentum and tries to go against momentum just before it changes. So all trading is built around momentum or anti-momentum. So I have a lot of followers who are interested in trend following, like trend following and momentum. So that was an article that they really liked. He has lots more good quotes in there, but that was the favorite one.
Yeah, I don't know. I don't have much to say about that. I think that's absolutely true.
And I think it is obviously true that you're going to go with momentum, you're going to go against momentum and with mean reversion. But then to complicate it even more, you have everyone out there with different definitions of momentum. One day, 2 day, or for me, it's hundreds of days of momentum. So it's very confusing. And I guess you can use momentum any way you want to. Give yourself a high grade.
Yeah, it reminds me of our conversation. I know we've referred to it a couple of times already, even though it's only a few weeks ago. But our conversation with Wayne, where he kind of told a story about how he was observing all of his colleagues as a young kid getting into this industry, and they were all doing mean reversion. And he thought to himself, well, maybe I should try mean expansion, which is obviously momentum. So yeah, I mean, it all boils down to, I guess, one side or the other of that coin.
Yeah, everybody needs something to move. And back to the AQR study we talked about last week, it seems that there hasn't been a lot of movement in the markets that we've traditionally had to produce profits for trend followers, so except equities. And so now we offer people lots of other markets other than equities and some shorts, and we underperform. Which leads me into maybe the final one that we can talk about.
Sure.
This was a study done by Lixor, talking about CTA strategies. Had a good April, I think. April. And I got some criticism for this tweet, but it wasn't mine. It was just a quote. Despite the poor performance of CTAs in 2018, investors should keep in mind that over the past 20 years, CTAs outperformed equities with a low correlation to global stocks, lower volatility in returns, and a lower max drawdown, 23% drawdown versus 55% for stocks. So 20 years, that's, you got to go back a long time. And maybe this article was being accused, and me as well, of cherry picking 20 years.
Yeah.
Whatever. I don't know. But there are people out there who love trend following, and they listen over the years at how wonderful it is. They have good experiences, and it goes a few years without performance, and they get very uptight and negative. And, I feel like I've done that over the years as well. And with my sports teams, I've often mentioned how one of the biases or human failings in life is not liking losses, and the losses being more hard on you than the winners. And so maybe this feeds into taking smaller profits, and not limiting your losses. And I feel the same way in sports. And there's been a few times over the years that my teams have let me down so much that I kind of turned on them all of a sudden, where I was like anti the Atlanta Braves when I was in my 30s. And they just would always win their division and lose in the playoffs. And it just became where I just had to root against them to preserve my sanity. And I feel like that this is something that's maybe happening with former friends of trend following, is that they've just had it, and it's ruining their day and their life to continue rooting for this strategy.
No, I mean, I think there's some truth to it. And I think that's one thing that maybe is something that we don't think much about, but I think it is very relevant. And I heard it in a meeting, last year, someone saying, so we meet this firm, and it had lots of money under management, zero allocation to trend following. And the guy goes and he says, I know I'm biased against trend following because I came into this industry in 2009, and it hasn't really made any money since 2009, which is not entirely true. Maybe for the indices, but not for individual managers. But anyways, so he was aware of his own bias against the strategy. And I'm just thinking, of course, I mean, your entry point will have a big influence on, and maybe so, and this is pure speculation, of course, but maybe a lot of, let's just say maybe a lot of journalists out there who've only been around, 10 years, don't really have a great impression of the strategy. So it's easy for them to kind of find negative associations when they write their articles. Maybe people who came into, the equity world in 2000 and saw what happened and the losses and two big drawdowns in 10 years. And it took, 10 years at least to, make back the money you lost if you had invested right around 2000. I mean, I remember I started in, I think I started in the investment area of the bank where I worked in 1987. So clearly that had a big impact on me. I think, historically, I had probably been risk averse because that was my first experience, was to see all these clients lose all that money in the fall of '87. So I think it stays with you. So I think there's something about that, and so it'll probably take a long. So when they object to, picking a 20-year, I mean, sure, I mean they can have their objections and their biases, but whether of course you have to pick a longer period. You can't just pick 10 years because that would have been unfair if you looked at 2000 to 2010 for equities. So you have to go beyond these cycles. So whether it's 20 years or 25 years, the truth of the matter is that a lot of people don't want to, accept what the data is showing them. And there is never been a white paper written that suggests that, if you combine what we do with stocks and bonds, you actually get a better risk-adjusted return out of it. Yet a lot of people won't accept that, and they still think that equities, just because they've done well in the last 10 years or so, is the only game in town. Good stuff. Anything else from social media, or do you want to jump into some questions, Jerry?
Let's do some questions.
Now, the first one, I'm not so sure. I don't really know what the question is. Well, I do. It's from Brian, and Brian has sent in questions before, so thanks for this, Brian. I think what Brian is bringing up is the VIX. I mean, he says that the VIX confuses me, and then the question is really, do trend following traders regard VIX futures uniquely compared to prices of other futures? And I can certainly answer that from our point of view, Brian, and that is yes. I mean, I mentioned the VIX often because it has usually either the highest move of the week or the lower, either up or down. But the VIX is not a market that we found a way to make money from as a long-term trend follower. Maybe if you were short-term, super short-term trend follower, and I don't even know if you can define a super short-term guy as a trend follower, but if you could, then maybe there's a ways to make money from that. But in our case, yes, we do trade the VIX, but that is the only thing we do which is not trend following. And so it has a very, very, very small role in what we do at all. So yeah, the VIX is it is a unique market, but it could offer potentially an uncorrelated return stream for people who trade it. But I think the more interesting question in my mind, I'd love to hear your opinion about this, Jerry, and that is that volatility, and let's just call it volatility expressed through the VIX. It used to be a measurement. It used to be something whereby we would describe risk. But now, and this is probably falls right into your lap in terms of topics you have strong opinions about. But nowadays, and most investors actually use that measurement to size their positions, to do their risk management. I will say that it is important to understand that this is something trend followers have been doing for decades. So for us, sizing positions based on volatility is nothing new. I think what is new about it is that in the last 10 or 15 years, everybody seems to be doing it now. And I do think that is an interesting conundrum, and potentially a source of risk that is well hidden in the system.
Oh, what do you mean by well hidden?
Well, meaning that if we then have a sudden explosion of volatility, then a lot of, and this goes back to probably your point about not necessarily just vol adjustment, but generally speaking, people who are then sitting with their portfolios looking at this expansion of volatility across the board, they all have to reduce their risk if indeed they take volatility into account, which I suspect most people do. And that could cause, some, massive run to the same exit, so to speak, in the markets. And maybe we saw a glimpse of it last year, or whether last year was a liquidity event or a vol event. I think there are people in both camps. But it is unusual, I guess, that you today have so many people doing the same thing when it comes to position sizing relative to when you and I started in this business, where there wasn't much talk about sizing positions based on volatility. I mean, risk parity as a strategy, which is very popular today, didn't exist back then.
Yeah, I think so often we talk about these same subjects, and we're not clear. I'm not clear, and people get uptight and point out these contradictions that we try to explain. But I guess it's worth it to say, I think setting up the relative positions in your portfolio, euro, dollars, S&P, gold, silver, corn, wheat, yen, Swiss, etc. I think it's a decent strategy to use the inverse of the volatility. And then that's where I stop. I'm done. Try to normalize the losses, give each trade the same room, and you don't really get into too much trouble with vol changes. If it's shortly after you put the trade on, it's going to keep going and turn into a winner, or it's probably going to turn into a loser pretty quickly. If it turns into a loser pretty quickly, it's probably not going to be a lot of vol expansion. But then as it does turn into profits, part of trend following is the trends, and then the vol heats up, and then you get this supersized position. Probably not going to have that trade turn into a loss, but it is a little uncomfortable, even if it's a nice profit, for it to be higher vol and not to make that vol adjustment down. And like you said, a lot of people do. They say, well, it's doubled in volatility. Even though it's a nice profit, I'm going to scale that back. So I think the problems that I see with that is promises are made to keep the vol in a certain range, the portfolio vol, and there's not a lot of delay. You don't really have a lot of discretion when you've made this promise. And so, right, everybody maybe runs for that exit to trim the positions a little bit almost at the same time. Unlike getting into a trend following trade. I mean, you're entering one day, I could enter a week later. And so, there's no urgency to sort of say, well, this is the place you must enter the trend or exit the trend. We all have our different look backs and strategies, but the vol targeting and the volatility adjustment, it's going to kind of come at the same time for lots of different people. And it's not the small guys, it's the billions dollar firms that are throwing S&Ps around Sunday night, and it can lead to big sell-offs. So this is definitely finessing that you would think would be a better strategy than sort of indiscriminately, trying to measure that vol and take care of it right away. And what usually happens is, well, not usually, but sometimes what happens is that the very trade that had to be done to get the position in line with the vol creates another trade, because now vol is even higher. So it feeds on itself. We're out of control. It's chaos.
Yeah. And of course, when we talk about these things, I think it is important to, at least in my opinion, I mean, you may have a different opinion, but by my opinion, I think the amounts of money that, targets volatility in terms of strategies, I think CTAs and trend followers, we are in the minority here. I really don't think that we are the ones, doing a lot of these on a total basis. I don't think we are the ones moving the majority of the trades compared to risk parity and, long short equity, whatever it might be. I mean, I think there's a lot other strategies, plus just underlying investors who are not necessarily engaging a manager, but just managing the big pension funds or whatever. That's just managing their own portfolio, but also have something similar in their approach, because they may have read about it and so on and so forth. So, but it's an interesting point. And Brian, just to clarify, no, I would say probably when it comes to the VIX, it's not something you would have a lot of success trying to do as a trend follower. Next question is from Kevin. This is about commodities. Kevin writes, do you think there is any reason to believe that an increase in institutions investing in long-only commodity strategies post-2008 could be contributing to the reduction in trends, at least in one direction? So I'm going to let you start on this one, Jerry.
Oh, can you repeat the question? My brain was thinking of the VIX again. Sorry.
Sure. Kevin writes, do you think that there is any reason to believe that an increase in institutions investing in long-only commodity strategy post-2008 could be contributing to the reduction in trends, bracket, at least in one direction? I mean, probably thinking of short, even though not so sure if that's really what happened. But anyway, do you have any thoughts about impact of institutions investing in long-only commodity funds?
I don't. I mean, I think I didn't know that it was still a big thing. I know it was big 06, 07, yeah, 08, but I didn't know it was still out there. I think I do think that institutions and people investing in long-only stock funds probably is fueling the rally and that sort of stuff. But I doubt if, as the commodities continue to go down, I'm not sure why, if there's a lot of buying into commodity index funds, why they're not going up like the stocks are going up. So now I'm confused by that.
Yeah, no, that's I kind of sit back with the same feeling on that. That first of all, I don't know that actually commodities have been on a on a massive uptrend, and certainly not in recent times. Someone I read many years ago an analysis, and I think this was maybe some of the bigger commodity markets like gold, et cetera, but it could well be true for other commodities as well. And that is, if you look over a 30 or 34-year cycle of commodity prices, actually the majority of the time commodity prices go down. But they still move up probably over time, but it's a shorter time frame where they really move up. So, and I don't know if these cycles are really that impacted, or whether when we see big institutions coming into the markets, well, that's exactly what makes up these, 1/3, 40% of the time where the markets do move up. I don't think necessarily that changes. But I do agree with you on the equity side that there has been a big shift in the way people invest in equities through these passive funds, and that certainly has put some tailwind in equity markets in recent years. But we appreciate the question, Kevin. Next question is from James. This is a long one, so let me try and distill it a little bit. Okay, this is interesting. This is completely different from, and let me just say this, generally speaking, we get a lot of questions about, the trading side, for good reasons, the trading side and how to create models or how to think about certain things within your model on the podcast. But we are equally interested in questions from investors, how to use trend following in your portfolio and so on and so forth. So feel free to send us some of this. So the question here actually is slightly different. This is about how to, and I think this is underappreciated by many people. They think the hard part of running a CTA business is developing the models and trying to get the best possible models. I actually think nowadays the hardest part is to grow the business, frankly. Because without clients, it doesn't really matter how good your model is. Anyway, so the question is a little bit related to that, I think. So James is writing, I do have a question for all of you, which is related to getting a fund up and running. My experience to date is that it is very, very hard. The barrier to entry these days with startup costs and regulation seems to be impenetrable unless you have fallen out of Goldman Sachs and been given a large seed ticket. I believe I have developed, tested, and now traded on a personal account for 3 years, a strategy that could easily fit nicely as part of a diversified portfolio for high net worth individuals, albeit a considerable part, because, like all of you, I firmly believe, based on the analysis I've done, that a CTA only starts to add value to a portfolio when it has an allocation of at least 20%. I would be really interested to get your thoughts on how emerging traders who are self-taught can go from managing personal money to third-party money in the current regulatory environment. So a different question, but a question both you and I have faced in our career. So what say you, Mr. Parker?
Boy, I wish I knew the answer to that. That's a tough question. I'm not inexperienced or experienced. I think it's tough to get going and impress people today with your sort of systematic approach. I would suggest, I have no idea how to do this, but I can guarantee you that one of the best ways of doing this is to find somebody to work for. I think a person who is working with software, their spreadsheets or whatever, coming up with their own system, they don't really understand and realize the deficiencies and how somebody else can help them along the way. And getting in with a group of traders or a trading firm in some way, and just planning on it being a long road. But starting out on your own in this particular business, and then saying, "Hey, why won't someone hire me? Can't you see by this evidence that I have a great system and it should fit in wonderfully?" No, that's not something that's probably going to happen too often unless you have a reputation in another way, a PhD, or I don't know. But I definitely am a big fan of learning from others, paying your dues. Make this a long-term project, as it relates to understanding that just because you may even have a great idea and a great approach, it may still take longer than it should or you want it to.
Yeah, no, absolutely. I completely agree with all of that. I think it has become, I agree with James. I mean, it has become really, really tough to start and launch not just a CTA business, but, any investment business with regulation as it is. But I think also with the appetite from investors to seed and be early, I think there's less and less appetite within the investor community for that. And if there is nowadays, a lot of them require some really tough conditions to be put in place. Even things like, first loss clauses where the manager has to absorb the first loss themselves and so on and so forth. So it is hard. And, having been on that side of the business for more than 30 years, I would say that it's probably the toughest environment that I've ever experienced. But it doesn't mean that it can't be done. But I think it requires other techniques. The way we did it in the 90s in terms of marketing our products, I don't think that's the way we should do it today. I think the way that a lot of people, and I don't mean to criticize, but I think if you just do it like everyone else is doing the marketing of your product, I don't think you will attract a lot of attention unless you have a product that is just so good that it, too good to ignore, so to speak. But, that's rarely the case. So I think you need to think outside the box and do things that other people aren't and add value. Do things that add values to people's life. But then to go back to your point, Jerry, I would also question, frankly, people should think very carefully about shifting from managing quote unquote family and friends and own money to managing really external capital where you need all the regulation and so on and so forth. And as I said before, a lot of people think that the hard part of what we do is developing the models. I'm not so sure that that's the case anymore. I think building businesses, running them, growing them, is probably the hardest part of the CTA side today. Now you need smart people and good ideas to come up with models that are better and different and all of that. I understand that, but there's a lot of smart people out there who can do that and may have done that. But there aren't that many people who can then go and turn that into a business, or find someone who can then turn that into a successful business. I see fewer of those, at least, because you never hear anyone who come up with this. The problem is always, oh, I've got this great model. How do I go and raise $1 billion? You rarely hear people say, I've got $1 billion. How do I go and create a good model? So I think it's a very interesting point that you raised, James. And I think a lot of people are thinking about this. We get a lot of other emails about people who've developed a strategy and they want ideas or help to get it going. But it's tough.
We have a friend, Peter Borish, who works at a firm in New York that tries to find good traders and coach them up and help them become better traders. There's ways to make it happen. I just think your attitude needs to be, how can I fit in with what clients want, versus, hey, it's obvious I have something going on here. Give me a lot of money. Can't you see the evidence? And I think back to what you were saying is it's two different skill sets. You have the strategist and the analyst and the computer guys and the system builders who need to partner up with people who are saying, let's tone it down and take your good ideas and make it fit into a strategy that meets the needs of real clients. And I think if you have both of those going on at the same time, but usually you don't, you just have a group of people who are super smart, who come up with systems, and it's the dumb clients out there who don't understand how great this is and they should be buying this. So you have to have both, because ultimately people have needs and they're looking for solutions, but we're talking past each other sometimes.
Yeah, no, that's a great point. And just as a spontaneous plug, but maybe just to gauge the interest with our audience. So if you're out there listening and you have an interest, a deep interest in what we do, which I hope most of you do have, Moritz, Jerry, and I have been contemplating doing a live event for a small group of people, maybe 10 of you, maybe 15 of you, but a very exclusive live event, a couple of days, where we would get together and try and create some breakthroughs for those of you who are willing to step up. And we haven't decided for sure, but we're thinking about it. So of course, if there are people out there who say, yeah, we would be up for it. It won't be cheap, so it'll definitely have a decent price tag for us to do it. It'll probably be in the US or it'll be in Europe or both, if demand is big enough. But if you want to speed up your learning curve from all of the years' experience that we can offer as a trio, then let us know. Send us an email, info@toptradersunplugged.com, and give us your thoughts. But it probably will be for a very small group of people who really want to take their trading or their business to the next level. With that said, here's a question from Rodney. Again, there's a longer email, so I'm going to try and just highlight the type of question. I think what Rodney is getting at, which I think is a fair point, and that is that we as managers, we trade diversified portfolios that include equities. But a lot of investors, including Rodney himself, have exposure to equities already through other means or other parts of the portfolio. So what Rodney is asking is, have you ever thought about marketing a trend-following fund that does not include equities? I wonder if this may have both an institutional and a retail appeal. What do you think the performance statistics would look like? ? I mean, I'm happy to go first on this one. So you bring up a couple of good points because you bring up the point about the performance statistics, and what I can almost say categorically for all trend followers, and that is, if you take out the equities, the performance won't look as good because equities have a diversifying effect in addition to an absolute return effect. So take a year like 2017, you would probably have had a quite a difficult year had you not had the equities, because equities, that's where all the trends were back then. But I understand what you're trying to get at, that when there are strong uptrends in equities, perhaps investors don't need more equities coming from their trend follower. And I've, come across that with real clients or potential clients on my side. But I, as a trend follower, I would say it's not really an idea that I would prefer, because I have to look at my product. I can't control what other people have in their portfolio and what they do with it. So what I can give them, from a trend following perspective, is the discipline. It's like a few years ago when people talked about interest rates, and a lot of people were saying, well, clearly interest rates can't go any lower, so why would we have any interest rates at this point? But indeed, they did go lower, and the people who made money from that was the disciplined trend followers sticking to their signals and their models. And I worry that if you take the discipline away from the equity part of the portfolio, you may potentially leave investors with a responsibility that they can't fulfill, because they may actually trim their own equity exposure at a time where equities are still heading higher. So, but I think it's an interesting point. What do you think, Jerry?
I'm going to take the opposite point of view on that one.
Yeah.
I think I think I've said it before. I think it would have been a better strategy, and I think it's unfortunately a better strategy now to totally reject the idea of crisis alpha and 5 or 10% or 3 or 2% to CTAs, and somebody other than me needs to sort of pick it up and say, look, here's the way we honestly all see it. And I believe I think there's a lot of people who see it this way. And that is, if you really want crisis alpha, if you really want the benefits of what we do, allocate some of your stock trading to us.
Yes, that I agree with. Yeah.
Right. So we're not going to, it doesn't add up. They don't really like CTAs. They don't really like trend following. And they want to allocate a small percentage, and then we will help when the stocks sell off temporarily. And it doesn't work. We don't help. And even if we did help, even if we did catch it just right, then it wouldn't be material to the portfolio. So now 2008, it was more than just a crisis. It was a bear market that stocks were down as much as over 50% at one point in 2008. So that's a prime situation where we could have the S&P hit a 200-day low in January of 2008. So if CTAs could have managed some of your stock positions, we would have been the index guys would have crushed it by getting short to flat in January, and the currencies and commodities and interest rates would have helped out in that year as well. And I traded single stocks, and I probably would not have been quite as good as being flat to short in January of all my stocks. But still, if you really want us to help, the trend following aspect of what we do is crucial, just as crucial for the stocks as it is all the other markets. So we need to, we were talking earlier about people who like to add CTAs because they really have a lot of stocks. And what do? They want us to change our strategy. Don't trade stocks, which is going to make our portfolio worse in the same way if we didn't trade commodities, if we didn't trade currencies, if we didn't trade bonds. We're taking away a sector that is profitable. And at some point in time, it may be the only thing that's profitable, the stocks, like they have been. So in 13 and 14. So the answer is give me some of those stocks to manage, And then not only will I be applying my trend following to those stocks and get you in the right ones and get you out of some of them and get short some of them, we'll have the currencies, commodities, and interest rates as well.
That's right. So you're in a sense taking things a little bit different than I am. What I was saying is just I don't think we as trend followers should change our programs to accommodate that. But what you're saying, which I completely agree with, is actually the investors need to think about their equity allocation differently. They should be doing equities long, short. They should allow us to not allow us, but I mean they should think about a different way than long only in their overall portfolio for stocks.
That's right. That's
yeah.
right. It's not just long only. It's if we only traded stocks, that would be fine as well. It's
Sure.
we're all in the stock market, and the trend following overlay on stocks yields different performance, and sometimes better, sometimes worse. It's a positive strategy for stocks. And so you add it to more of a buy and hold because, sometimes buy and hold is the only thing that works. I had another tweet this week that people liked, but it was CTAs enjoy the built-in risk control of trend following. As the market goes lower and lower against you, more and more against you, we get out of the trade. The trade becomes worse. We know exactly what to do. It's a worse trade. And for non-trend followers, it becomes possibly a better trade, which can kind of spin out of control, continuing to try to get in at a better bargain price. But what I left out was sometimes that works well. Trying to buy those lows, it's the only thing that will work. We've seen these crashes last February, end of last year, getting defensive, going with the trend is what we do. Yet as soon as we get out or go short, it rallies to new highs. So combining this momentum and mean reversion type strategies, don't leave your stocks out. They're so important to you. You need to add trend following to them.
Yeah. Good stuff. Thanks for the question, Rodney. Next question is from Sam. Sam is someone we like. I know you're active supporting us, Sam, in Twitter land especially. So that's great. Appreciate it. Sam has a question a little bit, I think, about, can you have too many things in your portfolio driven by a single driver? For example, he refers to, if you have a portfolio that is 12% allocated, for example, to FX, and in addition, there are some allocations. Let's see. I think what you're trying to get at, Sam, is, when you look at sector allocations in a trend following portfolio, is there a risk that's, a lot of it could be driven by, say, for example, currencies? You could have a lot of influence by moves in the FX part and so on and so forth. But I think the answer is that partly one of the reasons why both Jerry and I and Moritz are true believers in diversification is that we don't want our portfolios to be too much influenced by a single driver. Having said that, from time to time you probably can't avoid that. I mean, you especially we know with the dollar can be not only influencing the FX sector, it could influence the commodity sector, and it could theoretically influence both fixed income and equities from time to time, and maybe sometimes probably at the same time. So I don't think you can avoid that. But what we do on our side, and I think we probably all do that, is that when it comes to looking at position sizing and commitment to any one market, we treat them individually. So I mean, if there isn't anything going on in a particular market, then obviously we won't have exposure to that market. So you need to have the trend, the confidence in the trend strong in order to have a large exposure to a market. But of course, in theory, you can certainly have times where you end up with a lot of exposure across the board that potentially could be correlated to a single driver, such as the US dollar. That is not unreasonable to expect from time to time. And it could be also, another could be interest rates that is the single driver that has a big impact on your portfolio. Maybe not so much on commodities, but yeah. Anything you want to add to that, Jerry? I'm sure I messed up the question a little bit. Sorry about that, Tam, but I think that was the question.
Yeah, I mean, I thought about this issue when you were saying earlier that everyone thinks that the most important thing about a firm, starting a firm, or is this entries and exits in the system itself. And I thought, yeah, I think people do think that, but I think, in my opinion, something I think that goes not focused on enough is the portfolio, and being very concerned about these different drivers and getting too much of one versus the other. I think the issue you bring up is just, I think it's something that I don't want to try to control too much. If I have a diverse group of commodities and I have them, I realize, that maybe the crude and the heating oil and unleaded are kind of similar. So I'm going to trade those a little smaller. The same with the grains. They're kind of correlated. I'm going to maybe do some adjustment there. The metals, gold and silver, platinum, a lot of correlation there. I'm going to adjust that somewhat and just do some things like that because then your cotton, coffee, cocoa, and sugar, they're not that correlated to anything else. So don't screw up that correlation, that lack of correlation with trading too many precious metals or grains. And so I think once you kind of get that squared away and how important that is, there's 4 wheats out there. You're going to trade all 4. So you have the same size, as you would trade the corn. I think that's kind of probably something you don't want to do. But then all of a sudden, if something else extraneous happens, that they're all the commodities are sort of correlated for a period of time. I'm not going to try to figure out a way around that. That could just happen, I guess. So I think there needs to be a lot of thought and emphasis on trying to create a smoother performance out of a systematic approach that has 40% winning trades. And that really needs a lot of markets. But we can undermine the number of drivers we have if we don't take into consideration the correlation amongst the euro, the Swiss, the Swedish, and the bond markets are very correlated all of the time. So this is a puzzle that is a big part of what I try to work on. To make it a smoother ride, I need to be concerned with, what is driving the portfolio. And hey, there are 4 wheats out there. I guess I should trade all 4. I think that that's a major problem, and it's something that CTA industry has fallen a little short of. We have this diversification, but we have some responsibility. And just because this market exists doesn't mean you have to trade it if it's very similar to something else.
Yeah, no, I agree completely. We have another question from Michael, but Michael, your question is relating specifically to something that Moritz said. So since Moritz is quote unquote on assignment this week, I think I'm going to push that to next week or next time he's here. He may also be away next week. We'll see, but I appreciate the question. Next question is from Isit, and his question is, my question relates to a recent article published by Andreas Kleno, where he states that it is uncommon practice for an institution in the trend following space to add to winning positions. I know that the strategy taught by Richard Dennis to the Turtles relied heavily upon adding on to winning positions, and I myself have decided to incorporate this element into my own strategy. Well, is it you are in luck because we have someone here, namely Jerry, who can tell you exactly what he was taught by Richard Dennis. I don't know whether your statement is accurate or not, but I will let you take this one, Jerry, and tell us about what you were taught about adding to a winning position and any other thoughts you have about this.
Yeah, so at the risk of being wrong as to what this person is asking and their experiences, I'm just going to guess that this is another one of those situations that is very confusing. And I think that it revolves around a simple concept of multiple systems, entries and exits. So you buy the 20-day breakout. Then if it goes to the 50-day high, you buy the 50-day high. If it goes to 100-day high, you buy more at the 50-day high. So you have three different systems, and they all have the same risk profile. They all risk the same amount, and it's just a diversification of entries. And so sometimes you're going to get long all three as the trend keeps going, and sometimes you're going to go long system one at the 20-day high and system two at the 50-day high. And then that's it. It's going to reverse. So there's some diversification, and you're not really, each one of these three systems is independent. They're not based on the other systems. They're doing their own thing, and yet all you're just trying to achieve is some sort of diversification in entries. Now, I think adding to a position can also mean now that I am in system one, I can afford, from a money management point of view, to buy system two because I have a small profit in system one in this particular market. When this same market gets to the 50-day high, I'll now have enough profit to afford, from a money management point of view, to do this trade. I think that's a wrong, bad concept. That's a fleeting profit possibly that could go away, and you would have two losing trades eventually. We've seen that happen many times, of course. So adding to markets, yes, if it's part of multiple systems, but figuring out that a temporary or an open trade profit now affords me the ability to go long another market, I think that's what I would think that most people would say, no, that's not proper money management. Trade smaller, so you don't need an open profit to afford being able to do the next trade. Does that make sense?
Yeah, it makes perfect sense. I mean, I think in the old days, and I don't know if that's what I'm going to say is completely accurate, but I mean, I think in the old days there were people talking a lot about whether trend followers were pyramiding their positions, right? And I don't think pyramiding is the right way of describing what we do, at least what your firm is doing and what we're doing and what Moritz is doing. I mean, we're not pyramiding, but we're doing exactly as you say. We have different systems with different speeds, and we allow them to operate individually and independently, and therefore our positions build up slowly. But it's not kind of adding to a winning trades. It is part of the inbuilt diversification of the model that we don't want to enter all our risk at the same time. So we need different entry points. So I completely agree with what you said. And hopefully that is helpful. Do you want to add something to that?
I was just going to say pyramiding. Exactly. Pyramiding is bad.
Yeah.
Pyramiding is no good. That's the word I left out. But yeah, pyramiding versus multiple entries and exits. I'm going to risk 50 basis points divided by 3 because I have 3 different entries versus I'm going to risk 50 basis points on system 1 totally. And if system 1 has a profit in it, now I can afford to do system 2. No, that's pyramiding.
Yeah.
Money management needs to be more conservative.
Definitely.
Yes.
Cool. Thanks for the question. Final question today is from Todd, all the way from Hong Kong. And it's not directly related, but it's funnily enough a little bit related. And Todd rightly writes in to say, the three of us, we often use the terms, long-term, short-term, medium-term, et cetera, but long-term, or maybe I should do it in the other way around. I mean, short-term, what we think is short-term might be, medium-term for others, and what we think about as medium-term might be long-term for others. I mean, so he's asking if we could kind of define, and we're going to obviously maybe have to come back to Moritz and ask what his definition is, but he's asking if we could define how we think about these terms. So, I mean, what is short-term? What is medium-term? What is long-term? Have you got some kind of ballpark definition that you think about, Jerry, when you think about sort of time frame?
Well, I like to, when I do the back testing, I sort of have identified what I would consider to be a fruitful area as far as a look back period. And then I think you can just go too far. So I think super long term, maybe not, would just be defined as not that profitable. So at some point in time, you don't want to look back too far. But I think I would say that a good area to look into is the sort of the golden cross 50 crossing above the 250 or 200 moving average. That's, I think, fairly long term and fairly um, profitable, and probably a lot shorter term than that is, it'll just pop up. You just do your back test and you'll see, oh, okay, I see. The average trade is a lot smaller if I start changing those the 50 200 moving average crossover to 50 100 or 150. So I think the pay attention to the statistics of your back test, and maybe the 50 crossing above the 400. Maybe that's way too long term. So it'll pop up right in front of your eyes, and I don't think it's that material to put a label on it. Is it medium? Is it short? Is it long? I mean, obviously, a few days is short term to me. I think that a lot of these strategies, like the 50 crossing above the 200, is long term. It's profitable, and people hate it because you get some big drawdowns in some of the open trade profits. So it's probably three great characteristics. It's long term, it makes money, and most people hate it. Yeah, you're probably onto something.
Now, I would go a little bit further, Todd, and say, had you asked me this question 20 years ago, I would probably have a different definition, because back then we couldn't. Well, maybe we have to go back a little bit further than 20 years, but back then I would never have thought of. For me, short term would have been, at least a week. I mean, you have to have some data points, right? But nowadays, with computer power and all of that, of course, short term, you could think of that as being intraday or 1 day or 2 days. I mean, that's super short term. I think in the trend following, I mean, if we're, and also I don't even know if you can say that someone doing intraday trading is a trend follower. Of course, everything is a trend. I mean, on one hand, you can argue that and say, well, we're all buying to sell higher, we're all selling to buy lower, and so we're looking for some kind of directional move. That's a trend, regardless of time frame. So I'll accept that. But when I think about trend following, traditional trend following, I think you need a few days really in order to do something like that. Now, and so in anything up to a week or two, in my mind, generally is that's kind of short term trend following, at least if we add the word trend following to it. And therefore, medium term is probably from a few weeks, maybe 3 weeks, and a look back period up to a few months, maybe 3 months. And once you start getting past 3 months look back and further out, then you could maybe argue that it's long term, even though some people would say long term doesn't start even until you get to 12 months look back. And I can, that's probably true. From our point of view, when we talk about us being a longer term trend follower, we're definitely out in the sort of probably 9 to 18 months worth of look back, typically. Now, the reason I'm a little bit vague about it is that our systems are not static. So our look back periods can theoretically change, and they do change from time to time as part of the systematic approach we have to selection of parameters. But I would say that that's how I would look at our look back periods. We're certainly out in close to a year and further, and we would be classified as a long term trend follower. But here comes the caveat then. You can be long-term in your look-back period, but it doesn't actually mean you have to be slow in your reaction. And that's certainly something we've worked on, and I know we've touched upon this on the podcast before, and that is we have made some changes a few years back to allow us a quicker reaction when it comes to how we get out, because sometimes we feel, or our research suggests, that you have to react more quickly in order to not lose too much money or give back too much of the profits. So these time frames and trying to label managers in a certain box, I think, has become much harder, and maybe I would argue less relevant, other than, as Jerry suggests, if you just think about people as being short term, medium term, long term, maybe that's good enough conceptually to just put them in box. But whether they're actually 3 months or 6 months, maybe that doesn't really matter so much, because we're never going to react exactly the same to the markets in the future as we did to in the past. There's always going to be some new data set that will be slightly different. Anything you want to add on that, Jerry, before we head back to the usual programming, so to speak?
Yeah, you made a really good point. So you want to be long term. You kind of want to be not run out of these nice trends. Like cotton is a prime example.
Right.
So there was kind of a uncomfortable rally in cotton, short for a long time. Then it rallies like crazy, and you're like, oh gosh, I hate this long term stuff because this trend is obviously over, but it's not over. The back test is like, nah, it's noise, more noise than not noise.
Yeah.
It means nothing for this particular trade. But if you handled every single short or long in the same way that you handled cotton, it's going to be okay if you just want to hold on and have a longer look back period. And then you make a very good point. The whole point is to stay in this trend, stay in this skew. What is the definition of a long-term trend? Can it possibly be long-term like this? And the computer says, it's okay. You're going to have some drawdowns from your open profit. You're going to limit these losses to 25 basis points, 50 basis points. Very conservative. We're very interested in these max losses we have. But as far as the fluctuation against the trade itself and our open trade, we're going to be very liberal. And so then at some point, though, it becomes this really nice trade that you've been in for a long time. And because you had a long-term exit, you are still in it and you've built up this profit. And I think the point that I'm taking away from what you said may not be your point, but this long-term exit now could create giving back, all of the profit, too much of the profit. Months and months of the profit can go away in a couple of days or weeks. And so you need to figure out how you're going to not allow that to occur. And the long-term exits are fantastic in keeping you in these trends when it's getting going. It's not too much going on. It's not that material. It's not kind of worth it getting out, let's say. But then there will be extreme situations where you'll have crashes or monster rallies where you're like, okay, let's have another arrow in our quiver that we can handle situations like this as well. It's the downside of being long-term is that you have more open trade equity all the time than everyone else, but then you also are vulnerable for this give back. How are you going to deal with this?
And that's exactly right. I mean, I think a lot of people underestimate that when you deal in the world that we deal with and other investors deal with, there are so many variables in terms of outcomes that we have to allow for in our research. Because you're right. I mean, sometimes quicker exits works better than slower, but sometimes when it's the slower exits that works better than the quick ones. And I've certainly seen also. I mean, I think there's also periods where systems that use hard stops works better than systems that use maybe like we do, a more sort of a value at risk approach, and vice versa. There are so many possible outcomes, and we as trend followers, we're not the same. We all have our small differences, and so even though on the surface correlations might be high, we can see from the data that return disbursement is high as well. That means we're certainly not doing the same thing, which is, if you're an allocator out there, don't think that one trend follower is enough. I mean, you need several trend followers, in my opinion. Not too many. I can think of 3, but no, I mean, not too many. Not too many, of course. I don't think that's necessary in the same space, but you need also to diversify when it comes to your trend following exposure, for sure.
Yes.
Let me quickly run through performance to date for the industry, and then we can come back to maybe some final thoughts for this week. So this is, as usual, this is numbers that came in as of Thursday evening. And I think Friday was a good day. I'm guessing it was a good day for us. I'm guessing that probably other trend followers did well. B top 50 down 1.71 for the month of May, up 3.12 for the year. SocGen CTA index down 1.69 for the month, up 2.25 for the year. SocGen trend index down 2.2 for the month and up 4.85 for the year. And the short-term traders index down 57 basis points for the month and down 2.65 for the year. And the Bridge Alternatives Index down 1.16, up 2.95 for the year. I think before any final thoughts, but also before we kind of wrap up, I want to repeat just what I said earlier today. This thought experiments that Moritz, Jerry, and I are having at the moment. If you think that an intensive weekend of learning from the three of us, putting together our decades of experience, helping you create breakthroughs, either as someone who wants to learn more about trend following from a trading perspective, someone who might want to learn about how to build a business from from what you've got, et cetera. Between the three of us, we've done that for a long time, and if you think it would be worth coming and spending a weekend with us as we consider doing an event like that, then let us know. Send us an email at info@toptradersunplugged.com so we can gauge whether there is an interest for doing this. And as I said, be prepared that there will be a price tag for it, but let's see if there's enough people who would want to sit down with us in a small group setting. Any final thoughts, Jerry, as we begin to wrap up?
Well, I think last week was a good learning lesson. We keep needing to learn the same lessons over again, and I think one of the most important things to always say about systematic rules-based trend trading is you can't predict the markets. No one can predict. Limit up today can be limit down tomorrow in the same market. I've seen it a million times. And as bearish as, and as bad as we're feeling last week with the stocks going down, it's pretty obvious they're going to crash now. This is the same thing we've seen, sitting on your hands and waiting for those exits that, for the most part, never occurred in my stocks, and watching them rally from, unable to explain why they're going down, and the panic that was setting in over something like trade that is going to play out over a long period of time. And then all of a sudden seeing it rally just reinforces that. Stick with your entries and exits and your rules, because you really can't predict. Minimize your regret. And you're going to have more regret by not following your systems.
Fade the fundamentals.
Whenever possible. Be happy to do that.
No, I think that's I think this is a super good point to make and leave you with. And actually, it goes even to the point about trend following as a strategy. I mean, in the doldrums of the fall of last year and everybody being unhappy, I mean, we've now had 4 or 5 months of really solid performance from the industry, from individual managers, and you just have to be disciplined enough on all levels to stay with what works. And again, just like I mentioned earlier, where there's really not been a white paper ever written to disprove the old Dr. Lindner analysis and thesis. Ray Dalio has made this point as well. I mean, the secret to his success has been the diversification across uncorrelated return streams. And if there's anything that is uncorrelated over time to equities and bonds, it really is a diversified trend following strategy. So we hope to be back with our usual lineup next week, but it could be that Moritz is out next weekend as well. But If he is, then Jerry and I will be happy to wave the flag here. And so send us your questions as usual to info@toptradersunplugged.com. Yeah, on that note, I think we'll wrap up this conversation. We hope you enjoyed it. And if you did like what you heard, of course, we always ask for you to consider leaving a rating and review on iTunes. We can't get enough of those. And the reason being, it really helps the Apple algorithm to detect our little podcast and to feature it well in the rankings, which means a lot more people will discover it and enjoy, and not enjoy, but join our, hopefully enjoy, but join our little trend following crusade here. So from Jerry and me, thanks so much for listening. And we look forward to being back with you on next week's edition of The Systematic Investor. And in the meantime, we hope you have a great week.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.